All right, welcome to The Explainer. Today we're jumping into a really fascinating investment case study. It's all about Abbott Laboratories, a huge healthcare company that, not too long ago, found itself staring down some seriously scary headlines. And we're going to break down how some savvy investors managed to turn all that fear into a huge opportunity.
Okay, so let's get right to the heart of it, because this is the central puzzle. While pretty much the whole market was running for the hills, terrified by these lawsuits, a few professional investors saw something else. They saw a rare opportunity hiding in plain sight. They weren't just ignoring the fear, they were actually building a strategy to profit from it.
And this is why everyone was so scared. This number represents a single, massive jury verdict against Abbott. You know, a verdict like this, it just sends shockwaves through the market. It creates this huge cloud of uncertainty and panic around the stock. It's exactly the kind of headline that makes you want to hit the sell button, not buy. So with that kind of risk hanging in the air, how do you make a really confident bet on the company without just, buying the stock and hoping for the best? Well, these investors used a very specific and, I think, kind of brilliant financial tool to do just that. They used something called a cash-secured put. Now, the easiest way to wrap your head around this is to think of it like you're playing the role of an insurance company. You get paid cash today, that's called the premium, and in exchange, you make a promise to buy a stock tomorrow, but only if its price falls below a level that you get to choose beforehand.
Okay, so let's look at the actual architecture of this trade, because this is where it gets really clever. The stock was trading around $128, but these investors, they only agreed to buy it if it fell all the way down to $110. That's the strike price. And just for making that promise, they were paid $5.10 for every single share. It's a setup with a huge margin of safety baked right in.
And that little premium, it really adds up. For a big, institutional-sized position, this one agreement generated over $500,000 in immediate cash. I mean, that's money in the bank on day one. An instant return just for making a promise.
And here's the kicker. This is the really crucial part. If Abbott's stock did actually fall and the investors were forced to buy it, their real purchase price wouldn't even be that $110 strike price. No, it would be $104.90. Why? Because you subtract the cash premium they already pocketed. That is a deep, deep discount from where the stock was actually trading.
So, that begs the question, right? Where did this huge fear premium even come from? Well, it turns out it was based on a lawsuit story that was already falling apart behind the scenes. The market was pricing in the fear from a year ago, not the reality of what was happening in the moment.
This timeline tells the whole story perfectly. You start here, mid-2024, with peak fear after that massive verdict. Then, full-blown market panic sets in, with analysts talking about a $10 billion worst-case scenario. But then, look what happens next. The tide starts to turn. In the much more disciplined federal court system, a judge starts systematically taking apart the plaintiff's best-guess test cases one by one.
And this quote right here, this is the legal turning point. The judge issued what's called a summary judgment, which is basically a knockout punch in the legal world. It means the evidence was so flimsy it couldn't even be shown to a jury. And when your best test cases can't even get to trial, well, your whole argument starts to collapse.
Okay, so if the legal risk was way overblown and already fading, what about the downside? What's to stop the stock from just collapsing anyway? This is where the investors identified what they called the iron floor. They saw it as this three-layered safety net. First up, just pure valuation. At that lower price, the stock would be historically cheap. Second, the dividend. I mean, Abbott has raised its dividend for 53 straight years. If the price drops, the dividend yield goes way up, and big income-focused funds are almost automatically forced to start buying. And third, you had Wall Street itself. Analysts were overwhelmingly positive on the stock.
This chart is incredible. It just shows you how massive the disconnect was. Look at that strike price of $110. Now look at the lowest price target from any analyst on Wall Street, $136. Even the biggest pessimist on the street thought the stock was worth 23% more than the price these investors were agreeing to maybe buy it at. That is a huge gap between fear and fundamentals.
But here's the thing. This wasn't just about playing defense on a cheap stock. No, this was also a bet on a powerful growth engine that the market, completely distracted by all the lawsuit noise, was just totally missing.
See, under the surface, Abbott's diabetes business was doing this radical pivot. It was morphing from this old-school medical device company, selling complex products to doctors, into a modern, mass-market consumer tech company selling biowearables directly to you and me.
And they were doing this with a whole new wave of products. They were building on their massively successful glucose monitor, the Freestyle Libre, and launching new over-the-counter devices for athletes, for wellness nuts, and for a huge underserved diabetic market. This was a move that expanded their potential customer base from millions to well over 100 million people.
So when you boil it all down, this entire strategy was brilliantly designed to do one thing: profit from the massive gap between perception and reality. The perception was crippling lawsuits, an immense risk. The reality? Fading legal troubles, a rock-solid valuation floor, and a hidden consumer tech business that was about to explode.
And that really leaves us with a bigger question, doesn't it? One that goes way beyond just one stock. It forces us to think about how often we mistake the loud, scary perception of risk for what the risk actually is. And more importantly, what incredible opportunities are we all missing when we do?